Hello, investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Russell 2000 index, ticker symbol RUT. And as I do each and every week, I've left my lines on the chart so you can see how accurate the forecasts were when we are using candle charts as the main tool. As I zoom in here, you'll see that this is the line that I drew last week where I said we would most likely pull back to fill this minor gap. You see that horizontal line right there that I drew? That's the gap fill point. And if you've been following along with the market guys, you'll know that 80% of the time when a gap is left open, the gap will eventually fill. So we saw that happen. Now you'll see right at the end of the forecast line here, I said that once the gap fills, we will most likely bounce because 80% of the time, guess what? Yes, after a gap fills 80% of the time, the prices reverse. And again, that's exactly what happened. So we were spot on with that forecast. But what does that mean for next week? Well, I'm going to erase all these lines so that I can show you exactly what we're going to expect for next week. I'm going to have to zoom in just a little bit more because you'll see yesterday, which is the 5th of September, the Russell 2000 gapped up. So we now have another minor gap below the market right there. So I'm going to draw a line horizontal from that gap fill point because, again, the gap rule applies where 80% of the time gaps fill. So I'm expecting next week the Russell 2000 to pull back to fill that gap, and then I'm going to do just what I did last week and tell you that 80% of the time after the gap fills, it will most likely bounce, and that's exactly what I think will happen for next week. Notice down here, the CCI, which is the Commodity Channel Index, is a very sensitive indicator, so it's giving us a hinge right here. I call that a hinge because it's gone from an upward direction to a slight downward direction, and that's telling us that the momentum is shifting to the downside. So that confirms my forecast for next week, and that will pull back to fill the gap, and then we'll have to keep an eye on that CCI to see whether or not it reverses at the gap fill point, giving us a possible buy signal. So that's the Russell 2000. Now, if we look at the SPY, which is the S&P 500 ETF, same thing. I said we would most likely pull back to fill the gap. There's the gap fill point. You see that right there? So we filled the gap on Tuesday, and then what happened? We bounced. And we bounced in a pretty significant way because you can see that the price went almost vertical right here. And this candle, as I record this on the 6th of September, that's a spinning top, very close to what we know is a doji. That's a sign of indecision that is generally found at pivot points. And you can see back here, we had a doji. And here we had another doji, and what happened? The price dropped from that pivot point. So I'm going to erase all these lines and point out yet another gap on the S&P. Right here, we have a gap that still needs to be filled. So I think, like the Russell 2000, I think the S&P could pull back to fill that gap, and then I think we'll see a bounce from that particular point. Now, this is going to be a 2-week forecast in my timeline, so we're going to leave that in there for a couple of weeks to see how that pans out. But it looks like there's a good chance that this gap will fill for a couple of reasons. Not only because we see the spinny top slash doji, but we see the CCI down there starting to hinge in an overbought condition. The CCI over 100, which is that horizontal line right there that's colored in red, that is telling us that the market is in overbought territory. The stochastics right here is also in an overbought condition. So I think the stochastics will start to pull back because the CCI is already doing that. And finally, we keep a very close eye on volume. So when prices are going up and you see a drop in the volume right there, that's telling us that the buyers are running out of some of that momentum. So that is a bearish indication for the S&P. So if you have any long positions, you might want to protect those profits and possibly put in some stops, maybe use some options if you're an option trader, protect the downside. But I would be very cautious of any new buying, because one other thing that I'd like to point out is we have a wide divergence right here from that 20-period moving average. The market does not like to stay that far above the moving average, so there's the rubber band effect taking place where we could again see a snapback to that moving average. So that's the spiders. If we look at the Qs, that's QQQ. That's more or less the tech sector. We're seeing the same play over again. I said we would most likely pull back to fill the gap. This horizontal line was the gap fill point. It did just that. Right here on Tuesday, it filled the gap, and then what happened? It bounced just like I said it would. And the Qs has also gapped up right here. So I'm going to erase all these lines and draw another horizontal line to that gap fill point right there. That's a horizontal line. We call that flat line support. That's a gap fill support level. I think, again, like the other markets, we'll see a pullback in the tech sector to fill the gap, and then a possible bounce from that point. Again, this is a 2-week forecast that I'm drawing, with the end of the line right there being my target. CCI pulling lower, the stochastics overbought, the volume is dropping. Same story. So let's take a look at the diamonds, and then I'm going to go to the VIX. The diamonds also pulled back to the gap fill point. You'll see this was the target. We hit that target on Tuesday. We rallied up with a gap up on Wednesday. Thursday, we gapped up again, and today we have a spinning top on lower volume. I don't think I need to repeat myself. Those are all bearish indications, and I believe that we'll see a gap fill on the way down as the diamonds pull back as well. Now, we have a wide divergence from that 20-period moving average, but as this gap starts to fill, this moving average will start to move up and possibly meet the price action in the middle. So again, I think we'll see a bounce once that gap fills. We'll have to see whether or not this gap fills. I don't think that'll do it right away because this would be a pretty significant pullback to the moving average. We have the CCI again hinging lower. That's a bearish indication. Stochastics here overbought, over 80% on that scale from 0 to 100. And we see a drop in the volume. Now, finally, let's look at the leading indicator known as the VIX. Volatility index went up early on Tuesday, but it did not hit my target price right there. And notice what's happening as I erase all these lines. Notice what is happening with the VIX. We have what's called a stale red light. That's a long stretch of red candles here. 1, 2, 3, 4 red candles in a row. And the VIX usually does not go that long without a reversal. So I think right away we're going to see a rally in the VIX and a gap fill point right there. So like the other gaps, there's an 80% chance that this gap will fill. And because the volatility index is inversely related to the S&P, a bullish VIX, like we see here, is bearish for the S&P. You can see that the CCI has not turned up just yet, but I think it will. So I'm going to forecast the CCI, and I think that the stochastics will also start to move up just like that. So we'll leave those in place for next week to see whether or not those forecasts come true. And again, 80% chance that that gap will fill. Now, finally, I'm going to add something on here. Again, looking back at the diamonds, we're hearing a lot of talk about a possible recession, right? Now, let me explain something to you. When Charles Dow created the Dow Jones Industrial Average, he did so with the intention of creating an economic indicator. His idea was that if you track the 30 most powerful companies in the country that drive the economy, these would be our leading indicators. So he did not create the Dow Jones Industrial Average for us to forecast the stock market per se. He created this as an indicator to forecast the U.S. economy. So when I hear people tell me, oh, the recession is on the horizon, well, there's a possible recession risk, and we hear about the Fed possibly lowering rates to offset a recession, I go back to Dow Theory. And the Dow Jones Industrial Average generally leads the U.S. economy by 9 to 12 months. So as you can see here, since the end of 2008, beginning of 2009, this is a major bull trend. I do not see a major pullback in the Dow just yet. Now, that could all change, of course. But if the Dow starts dropping, then I would expect a recession on the horizon, possibly 9 months out. So don't believe everything you hear on the television there with the financial analysts or economic analysts forecasting recession. I don't see any sign of that just yet. Today's jobs numbers proved that while they didn't quite hit the targets, they didn't disappoint all that much. The job market is still strong. Unemployment numbers are still strong. We have economic indicators that are still pointing up. But these forecasts of a recession just drive me crazy because no one's paying attention to Dow Theory or the technical charts. And I just want to give that to you as an added bonus for value here. And the market guys pride ourselves on educational content. But again, I don't want to go against the whole world and say all these economists are wrong. They're crunching the data, but they're not paying attention to the Dow Jones Industrial Average, which in my opinion is the best leading indicator around. So you have a great weekend. We'll talk to you soon. So long.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.